You're looking at a separation that occurred in the last couple of years of those really big names. And what's really powerful is the other S&P 490 that come behind it. You take the top 5 stocks out of the market, the overall remaining S&P is trading at like 16.5 times next year. And at 2% interest rates, that's just too cheap. And if you combine that with what everyone's talking about, which is all the liquidity being poured in, not just by our Fed, but by the ECB, by the Bank of Japan and China, you're setting yourself up for probably the best year of cyclical stock performance in the last 10, maybe in the last 15. And you don't really need to worry about the other ones.
Peter, I get sweaty palms when I feel like we all think we've figured it out and there's no place for this market to go but up. Is there anything you're watching right now that gives you pause?
Well, you know, I'm hoping for 2020 to be the year of investing in common sense as opposed to common stocks. You know, this past year and actually several years, we spent a lot of time fretting about inverted yield curves, trading on presidential tweets, all kinds of technical issues that if we just turn to common sense and we start looking at individual stocks that have great demand, I think 2020 can be very, very promising, but not just talking about the technicals and how many stocks are in the S&P 500 and which ones are, you know, undervalued versus overvalued. That's important, but I think we've come a long way. We've drifted from thinking about what kind of stocks do we like, which ones do we think we can model more simply than, say, Peloton, for instance, where I have no idea how many people are going to be using exercise bikes after their New Year's resolutions wear off. But I have a much better sense of how many people are going to be worried about whether or not they get hacked with their home cameras, looking at their nurseries or having their television talk back to them.
And that's why, and not to cut you off, Peter, but that's why you like CyberArk. And then I saw Peloton. I thought this was a fitness chain, but it just sounds like one. Equinix. You like Equinix and CyberArk.
That's correct, yeah. And Equinix is actually data storage, whereas CyberArk is data security. So the data security means that none of us wants to get hacked, right? All the way from, as I said, your home nursery all the way to banking. So that's pretty common sense that nobody's going to skip on that kind of capital expenditure, right? And then on data storage, too. You know, I have this rule. It's the law of your grandmother's attic. No matter how large your attic is, it always seems to absorb all your junk, correct? And so with data storage, we as humans just create so much more data. It has to go somewhere. And to me, it's very obvious that a company like Equinix and several other competitors will be there because they need to be there to absorb all this stuff we create.
Jerry, yours is a broader spectrum of picks here and some more household names, though. You got JP Morgan, Conoco, and Texas Instruments. And we know that chips have done so well this decade as well, right?
Yeah, but following up on that, I mean, the storage play is simple and it's vast. And in my opinion, you know, Texas Instruments at its current multiple is a wonderful way to play that trend and watch it to continue because the cycle, I think, is still there. More interesting, though, are names like Conoco and JP Morgan that haven't been part of this last 10 years by any stretch, and yet Conoco Management is out with a strategy of buying essentially 100% of their capital back over the next 10 years. And JP Morgan, at its current multiple, is as cheap as you've ever seen a big financial name like this that has a huge, huge tailwind with the Fed and global liquidity coming at them. So it's just another example of how this overwhelming market breadth is poised here to be part of this cyclical run. And you, in my opinion, you don't have to go that far.